With more on the VIX, you might say, we're going to talk about this cheap insurance. And if Dom is right that it is a good time to buy some protection, or perhaps it's wasted money. Here to help us decide the difference between the two is Dean Curnutt, founder and CEO of Macro Risk Advisors. Dean helps clients make investment decisions by examining risk. Dean, before I do ask you that question about whether it's wasted money or not, I want to ask you about 1532 on the VIX. And I don't want to overemphasize this, but this really is our best gauge of fear. When was this VIX the last time at 15? It was, as Dom said, middle of 2007. The financial crisis was just in its earliest stages, right? We hadn't even hit the BNP Paribas moment in the beginning of August 2010 when the subprime crisis went global. How is that possible? Is this really that benign a time?
I think one thing to remember about 2007 was in early 2007, the VIX actually went below 10, 9.9, I think it was. And this was amidst a housing bubble that was clearly at absurd proportions and was on its way of unwinding. So there's definitely instances where investors can just brush aside some of the more systemically important developments and more be reactive to what's happening right now. And the situation right now is one where owning put options insurance has been a frustrating venture.
Do you think that the psychology has changed? Do you think that people are starting to view this more as an insurance instrument and less as something that people speculate on to make money on? Is it a cost of doing business now?
I think it's a little bit of both. I think it's a cost of doing business, but it's one that folks are not really willing to absorb. Investors demand real-time performance, and anytime you're buying put options these days, even in the wake of the unfortunate accident in Japan, the VIX went up to 29, but so quickly reversed its course that there's a certain degree of frustration with owning portfolio insurance at this point.
If you were to go out, try to give us a case example. If you were to go out as an equities manager and buy some of this portfolio insurance using put options, how much upside are you sacrificing over time?
I think one thing to remember is that the VIX option is a very short-dated measure of volatility. So it measures the cost of insuring a portfolio over the next month. And if you look out over 3 or 6 months, that cost starts to increase. So we have this what they call a term structure of volatility. That said, from my standpoint, with all the things happening right now, the sovereign risk issue, the Middle East, crude at 110, fiscal uncertainty in the U.S., to us at Macro Risk Advisors, why not just buy the shortest dated protection you can?
Dean, you were walking us through some of the components of what you call the octagon of uncertainty. The Middle East, for example, the deficit discussions here in the United States. Give us a sense of why it is that you've structured it. We're showing it to our viewers right now.
Well, one of the things that's been empowering this market is risk appetite, and that's one of our elements in the octagon uncertainty. We think it's vulnerable to all the other elements, which are things like housing, the Middle East, the price of crude, the sovereign situation in Europe, and now more recently, Fed uncertainty and monetary policy at the end of QE2. And then lastly, the fiscal uncertainty, this newfound rigor with which the debate about U.S. indebtedness is taking hold, I think is a big deal as well.
When we talk about the ETF market, there's an ETF for just about everything now. Like there's an app on your iPhone for everything. So there are exchange-traded type products that track the VIX or other options markets. So should people be looking at that or just using the straight-up options? What's the better play here?
We're more a fan of using the options. We think that anytime you construct a hedge, it's got to be extremely liquid. You should be able to get in and out of that hedge very quickly. Now, some of the VIX ETNs have got some degree of liquidity, but they're also forced to constantly roll VIX futures, which can be a costly exercise.
Just like credit default swaps, which are also an insurance product, you can speculate on volatility using some of these ETF products. Is it crazy to be punting on volatility right now, given the vol of vol, so to speak, that we've seen?
I don't think it's. I wouldn't think about it as speculating. I think it's volatility is really one of the truly uncorrelated or negatively correlated.
You believe it's an asset class?
I do. Yeah, that's our business. So we're looking closely at that, and we think it's an asset class that's been unloved for a period of time. A lot of this is the Fed. The Fed's making it very difficult to be in cash. They're flooding the market with liquidity and making volatility very low.
Dean, thanks so much for joining us once again. Dean Curnutt of Macro Risk Advisors, helping us understand what it means to invest in volatility and whether it's a good idea to use it to protect against potential catastrophic drops in the stock market and elsewhere.